Hello, everyone, and thank you for tuning in today for the DoubleLine Diversified Fixed Income Webcast titled Labor at the Crossroads, What It Means for Fixed Income. Today's webcast features DoubleLine Deputy Chief Investment Officer Jeffrey Sherman. My name is Mike Marsala, and I'm a member of the firm's client portfolio management team. You'll hear from Mr. Sherman shortly, but first I'll go through a few housekeeping items. Three sections, starting with DoubleLine webcast updates, then a bit on thought leadership and media that you can consume, DoubleLine related, and finally, a bit on the four strategies that Mr. Sherman will cover today. So the next two slides here to cover webcast announcements. For all things DoubleLine webcast, you can follow the link at the bottom left of this slide to register for upcoming webcasts and to review replays of prior webcasts. For 2025, now that we're into October, we have two left after today. The first of which features DoubleLine portfolio managers Ken Shinoda and Robert Cohen, who will provide an update on the DoubleLine Multi-Sector Income ETF. The ticker symbol there is DMX. That's on November 18th. DMX is coming up on its one-year anniversary since launching last November and has enjoyed a strong relative start with year-to-date performance up 5.8% through yesterday and a 30-day SEC yield of more than 6% as of August 31st. And the last webcast of 2025 will take place on December 9th. That features Jeffrey Gunlock and Andrew Shu, who will provide an update on markets and the Total Return Bond Fund. Total Return has also performed well year to date, currently out in front of its benchmark, the Bloomberg US Aggregate Bond Index, by more than 50 basis points as of the end of the third quarter. And lastly, on webcasts, we have two new series, I should say, for 2026. You can see these series are called Gunlock Unlocked, featuring Jeffrey Gunlock, and Sherman Says with Jeffrey Sherman. These webcasts will not be necessarily fun to focus, but will instead focus on macroeconomic and market insights, and importantly, how to implement ideas into your portfolios. To register and save the dates for any of the 7 planned webcasts, simply follow the link at the bottom of this slide. And the next two slides will touch briefly on DoubleLine video, media, and thought leadership, where you can engage with DoubleLine to hear our latest thinking. Two examples. The first one here, as you can see on the top left, is Channel 11. This is a news anchor style show featuring portfolio manager Ken Shinoda, where Mr. Shinoda brings relevant market insights and commentary. Its cadence is roughly monthly, just depending on what's happening in the markets. And DoubleLine Minutes, which is a weekly podcast on Fridays. It's around 15 minutes in length and hosted by members of DoubleLine's macro asset allocation team. They provide in-depth coverage of that week's macroeconomic releases and the latest market activity. So think coverage of the labor market, inflation reports, and the like. You can find links to DoubleLine's full lineup of media and thought leadership across various platforms on the right-hand side of this slide. And then lastly, to touch on the 4 strategies that Mr. Sherman will cover shortly. This slide highlights the ticker symbols and minimums for each. And then I'll run through a standalone slide of each strategy to point out performance as of the end of the third quarter, as well as the most recent 30-day SEC yield. So starting with the DoubleLine Low Duration Bond Fund, this is a mutual fund in the short-term bond category. It's outperformed its benchmark by 124 basis points per annum on a net basis since inception and has a yield of 4.62%. The Flexible Income Fund, this is a mutual fund in the multi-sector bond category. It's outperformed its benchmark by 143 basis points per annum on a net basis since inception and has a current yield of 6.18%. The Core Fixed Income Fund, this is a mutual fund in the intermediate core plus bond category that has outperformed its benchmark by 119 basis points on a net basis since inception, has a yield of 4.76%. And then lastly, the Opportunistic Core Bond ETF, ticker symbol DV&D. This is also in the intermediate core plus bond category. It recently passed its 3-year track record in the first quarter of this year and has outperformed its benchmark on an annual basis by 102 basis points per annum. It has a yield of 4.52%. So we'll now move into the main presentation, starting with a macroeconomic update, and I'll turn it over to Jeffrey Sherman from here.
Okay, thanks, Michael, and thanks everyone for joining us today. We had a little bit of an earlier start time due to some scheduling conflicts, so thanks for joining us. And For those of you that couldn't make it, hope you're enjoying this replay. So I'd like to start off just kind of State of the Union. Where are we at in terms of growth rates? After the turmoil we saw back in April and some revisions to, whether or not the U.S. was going to go into recession, depression, or recover from everything, you can see that we have estimates now where it looks like the full calendar year will be about 2.3%. And as I look at that and rank that over the last 15 years, seems just about in the median, right? So for all the talk about the impact of some of these policies, we've sure seen resilience both in the labor market. We've seen it in the consumer. Those things are inextricably linked, and that's like today's focus is called labor in the crossroads, because I think that's the key point when we think about where policy is going in the near term. So this is what the economists think. If you go to the real-time data that's compiled by the Atlanta Fed and their GDP now, you can see here that the expectation is for about a 3.8% third quarter GDP growth. And so you can see here the evolution that you can see there's kind of this disjoint function because what happens as soon as GDP comes out, we get the print, then you get a new set of data. That's why it's kind of blocky when you look across this. But notice here that we've been kind of on this trend for a while here. The composition has changed. You can see here there's inventory building again, where there's a lot of drawn inventories, right? There was that stocking that we saw prior to the tariff policies coming in. Then those drawdowns, meaningful drawdown in the second quarter. Late second quarter, early third quarter. And we've seen quite the reversal here. And so as you can see, as we've got the data in here, and ultimately what you're finding is that it's really still driven by the consumer spending. And when we got the revisions to the second quarter GDP report as well, there was a revision in the consumer spending as well. So it seems that the consumer remains resilient thus far. Again, this is all backward-looking data. This is data that's been compiled to date. But that seems to be the critical crux or the crux of the U.S. economy today. And so some of this economic data has caused surprises to the market. I threw this in here because I was interesting because if you look at where the data has come in, the data had surprised mostly to the downside this year. And all of a sudden now we're starting to see some reversal. And if you look at the components there, you can see the bulk of this is actually driven by the housing market. And so potentially there's some more activity as people are thinking about Fed policy and rate cuts. We've seen mortgage rates come down a little bit over the last couple of months, along with when the 10-year Treasury has come down a bit. So there's been some surprising on that side of it. But you can still see that there is some softness on the labor side that's driving this down. So there tends to be kind of these two different effects that are pushing employment in the market today. And we know that one of the big drivers out there is spending. And so I'd be remiss if I didn't focus on, since the last time I did a webcast, we didn't have the one big beautiful bill yet. But you can see here that if you look at the total amount of government debt outstanding and you juxtapose that line or overlay that line of what the actual debt ceiling limit is, and you can see there's all those suspensions over the last decade or so. That's what the shaded areas are when they just don't care about the debt ceiling. Usually there's some sort of crisis or something else going on. But what you can find here is that when we passed the bill, they actually injected an incremental $5 trillion raise to the debt ceiling. So the government has stopped even pretending that we're going to try and balance the budget. We're just going to go ahead and continue to expand the overall deficit. And there's a couple ways of looking at this, is that you can look at it by how much are we actually spending as a function of the overall economy. And you can see here that there is this pretty big reliance on almost a quarter of the economy is driven by these government outlays. And so it's one way of saying it. So you look at the aggregate value of the GDP, you look at how much we're actually borrowing, and that's how you're looking at this. So these expenditures are a very meaningful part of the overall economy. And obviously with the government shut down right now, we're talking about potentially, I saw the president floating that the furloughed workers or even those working today aren't going to get paid back pay for all the time they've done. So we'll have to see if that's another one of these cost cutting schemes, or if it's just more politicking out there to try to negotiate a deal potentially quicker. The way I usually look at this is just what is the surplus or deficit as an overall percentage of GDP. And so you can see here that even in this period today, where we had this strong economy, where we were growing in the 3-4% over the last couple of years, Looks like, we're estimated to be in kind of the high, low to mid twos this year because of the first quarter. And, we're still running a massive deficit. And so there's not even this semblance or pretend that we're going to actually try to balance that. And so I think that's where some of the debt markets globally have woken up to the idea that the developed world is kind of laden in debt. And there's just there's no changing that path in the near term. And we've seen interest rates go up. This is the reason that Treasury Secretary Bessent is out there talking about he wants to get interest rates lower. This is why the president is likely arguing to have lower rates in the U.S. is that they realize that the amount of burden of all the debt issued over the last few years at higher rates is really starting to drag on the overall cost, which is now, if you annualize this is growing. Just the debt service alone is growing at almost $1 trillion a year. So it's not peanuts anymore. And there's a reason that potentially you see this idea of trying to influence the Federal Reserve to lower interest rates is because, again, it probably is in the public's interest. But the question is that does that just allow us to be more reckless? And so essentially, instead of the fiscal authorities trying to deal with their own ramifications, they're leaning on the arm of the monetary side to try to force that hand as well. So time will tell. We know that Chairman Powell is on his way out in May of next year. And so the clock is ticking on who the next person will be, and if there's more plays for various governor seats at the various board of governors across the Federal Reserve banks. One thing that we put together too, one of our portfolio managers was talking about, just what the outstanding debt looks like by coupon by maturity date. And so he took this area and looked at between the bills, kind of the shorter duration assets from those kind of, the coupon bearing where they have a coupon between 0 and 1%, 1 to 3, 3 to 4, 4 to 5, and 5 plus. And you can see there's not a lot of 5 plus out there. That's a good thing. They tend to be kind of in that shorter duration bucket out there. So they've been seasoned at this point. But what you find is that, the idea that we've had so much bill issuance, right? This is the one part that, at least with Federal Reserve policy and been in a cutting cycle over the last year or so, that you've seen more issuance on the front of the curve, is that's the cheapest place to borrow. And so this policy has continued as I think the Treasury Secretary doesn't want to go out and issue all this longer dated debt in today's levels. They're hoping to get rates down. Hope's not a very good strategy out there, but they're hoping if they can get rates down, then they can term out some more of this debt as well. But you notice here too that it is kind of this power law function. We look at the first couple that it declines quite precipitously, and you can see that there's just kind of this steady flow of maturities out there that have, some of them have actually relatively lower in coupons. So again, this is what the Treasury is trying to manage here, and there's about $6.5 billion that's still set to roll off between now and year end. And one more thing about the budget balance is that, what you usually see during the expansionary period is that we start mired in a pretty significant deficit because we had to spend to get our way out of the recession. And you can see that typically we bounce back relatively quickly, where it gets more in line or gets closer to being balanced, or at least doesn't run such a meaningful deficit. But notice here that red line, which is 2 recessions ago, and then the black line, which is the pandemic-induced recession too. Notice that these curves got actually steeper over time. And so this is just this structural deficit that we've ultimately been running even during the good times. And so for the last, let's call it, since the global financial crisis, almost 20 years now, we've just been running these massive deficits. And we all know that this is what starts it. It's because of the recession, because the denominator drops with GDP going down. And secondly, there's typically fiscal stimulus that's coming into the marketplace. But it's this previous chart that really just amazes me that, we're just not even trying to pretend anymore that we're going to even think about trying to balance, the spending with the tax revenues that come in. So let's get into what's going on and, looking at confidence indicators. Not a huge fan of confidence indicators, but I just wanted to show that the one area of the market that still is showing some optimism is the small business side. You still have the consumer confidence is still kind of having negative readings. You look at the CEOs, we look at home builders. If you look at these kind of key segments of the economy, the only one that's really feeling better about their prospects right now are small businesses. And you notice they seem to got some kick around the election last year. So I'm not sure that there's politics involved here, but probably this resurgence, some deregulation was thought of at the time. And then their confidence really collapsed, so optimism collapsed during the announcement of the tariff policies. And don't forget that small businesses tend to have a disproportionate impact because from the tariff policies have a disproportionate impact on small businesses. And that is because they typically don't have huge supply chains, right? They don't have the ability to negotiate. They also just don't have the ability to have fungibility across the supply chains as well. So it's much more difficult for these folks to stomach and weather that tariff policy. And so again, remember, this is where a lot of the jobs are in this country as well. So it's always good to keep a pulse on what's going on in small business. And if you look at they're optimistic, but if you take a look at their CapEx plans, it's pretty low. It's at relatively low levels. And so for all this optimism, it doesn't say that they want to expand. They're probably just hoping for the future right now. They feel optimistic, but not enough to kind of stake that CapEx at the time. You can see how it's really collapsed in the last few months as well. So again, I try to keep the pulse on this. This series doesn't say that anything, that at a certain level is a recessionary indicator or not. You can see some of this has been kind of the death of small business since the GFC, as we've seen just a proliferation of that mega cap and just kind of the largest companies winning. And so let's turn into kind of the economic data that we get from the private sector. Here's manufacturing and services. Manufacturing has been this contractionary reading for really the last 3+ years. There was a brief little hint towards the end of 2024, where you saw a little bit of this resurgence in manufacturing, but the services has really maintained above this kind of expansionary level. Today, their reading is neither expansionary nor recessionary. It's even at the 50 marker. And what usually you have to see here is that services need to dip down for multiple periods while coinciding with that manufacturing side to lead into a recession. So this kind of keeps you on watch a little bit. But again, it could be a function of the components driving this. And so let's dig deeper. And so one thing we've been watching, obviously, since both we had the inflationary regime back in the 2021 and 22 experience, along with this new tariff regime, is what are the prices paid? What are the input costs going into both manufacturing and services? And notice these here are very elevated levels. And so what this means, like a 69 reading, says that 69% of the respondents are saying that they're paying more for their input costs versus 31% not saying so. And so this is price pressure that seems to be coming through the overall system, not just on the manufacturing, but also in the services side as well. And secondly, when you look at the amount of people that are actually hiring people right now, there's more that are not hiring today than are actually hiring. And so this doesn't mean that there's people being laid off. It's just that it's not being expansionary on the employment side. And so you've started to see this specifically after a lot of this tariff policy kicked in. You're starting to see there kind of being some curtailment on that on the employment side on both of these areas. So again, these are things to watch, and probably another reason why the Fed is thinking about the labor market as well is that you're seeing some of these indicators start to give some on the weaker side of readings. And notice here that usually once you start to get these dip down for, call it 6 to 8 months, that's when you start to have the onset of that recession. So we'll have to see. Again, the one good thing is right now is that there's not meaningful layoffs out there. That seems to be endemic in the overall economy. One thing interesting about the inflation is that even with all of the kind of spikes from the tariffs, the things we've seen out there, it's actually the surprise indices. People actually thought it was going to be much worse. And so this probably gives a little bit of relief to markets, probably why you've seen a little bit in the rates market rally a little bit, as that the inflation's actually been surprising to the downside relative to expectations, but not really relative to where economists have been forecasting inflation. And so again, inflation we'll talk a little bit more about on the next slide here. And so as I said that, it's the expectations of inflation, but notice here that the core CPI, that's the black line there, has been on an uptrend. Yes, it went sideways the last month, but definitely we had that nadir from late last year. And so, but if you notice, you look within the components there, Well, notice what's starting to really kick in. If I look at where that increase in that year-over-year line started, it's when that dark blue area went positive again. And that dark blue area is core goods. So these are things that could be potentially impacted by tariffs as well. So again, as we start to look at this, you're starting to see even though shelter inflation is contributing less and less on a year-over-year basis, it's got that kind of downward slope. But also, if you look back relative to history prior to the pandemic, that shelter inflation tends to contribute about 100, 120 basis points to overall core CPI. But notice the services area, once you strip out shelter, continues to remain a big driver of inflation right now. And that's, part of the idea that people want to continue to do things. Even, maybe if you don't want to consume something because the price went up, maybe you just go and take the kids out to eat for dinner that night. Just because everything feels expensive, you just need a small luxury. So we're seeing that and kind of in that food away from home categories. You're seeing it in some of the leisure as well. You're not seeing these exotic, fancy vacations, but you are seeing, the hotel sector. You're seeing it. Someone on the airlines. You've definitely seen it in the transportation costs as well. So let's talk about labor. That's kind of the theme of the presentation. And so a lot is made out of this chart, and it has for the last, probably I'd say almost 10 years. And that's because what we've had is a market with much more demand for labor than actual supply of labor. And a lot of this started meaningfully during the pandemic. But if you look back at the last couple of years of the first Trump administration, we actually had this phenomenon where there was more demand for labor than supply. And this just didn't used to be the case. Over the last 25 years, when you look here, the aberration was that period. Obviously, we had the pandemic where, again, the economy shut down. But we've had this idea that we need more workers or the demand for labor is more than we can actually supply to the market. And so this is a challenge. So when we talk about a weakening labor market, and Jay Powell references 2 press conferences ago, he talked about the idea that, even though the demand for labor is going down, also the supply is going down. And so we're seeing this kind of strange equilibrium. I don't know if he used the word strange, but he called it an equilibrium. And so he also mentioned that he wanted to focus more on the unemployment rate than actually the jobs numbers. Now, there's been a lot made about the jobs numbers. I'll talk about that in a couple slides as well. But the idea that just because we have, a few more, in this case, we have 157,000 more people that are more people looking for work than actually are out there for job openings today, doesn't mean that we have this massively stretched labor market and there's a rampant unemployment issue. And so, again, some of this is attributed to the immigration policy. We've seen, kind of the deportation side of the equation where they've lost workers. We've also seen there be some fear out there and just the sentiment of there. So you're seeing this world where, the demand for labor is coming down, but so is the supply as well. And so, again, it's kind of staying somewhat balanced there. And even though we're seeing this weakness in labor, it's not translating into an overall massively weaker economy. And, the non-farm payrolls, a lot can be made about it. We had the revisions that came back where we somehow didn't create 911,000 jobs we thought we did. Got the person in charge of the BLS fired for that. Then I saw that someone was nominated, but I think that person got withdrawn recently. So I don't know who's going to be in charge of the BLS. Maybe it'll be Besson. I mean, I just read the other day that he's still in charge of the IRS as well. So you might as well just keep putting on more hats. The market seems to like the more he does. But notice where the jobs had been coming from. I mean, when you look at the jobs, they've all been in 2 areas. They've essentially been in education and health services for the last few years. And that's really been the big driver of the overall labor market and picture. Probably some of that has to do with an aging population. Again, we didn't get the differences between the two, but ultimately, the health services is like 99% of those overall numbers. I didn't break them out here. So anyway, when you put it back together, what you see here is that it's really a very narrow economy in the job creation. But again, you're not seeing this rampant layoff out there. And we look at continuing claims. Continuing claims are those people who have unemployment benefits. They continue to receive them. That's that gold or that goldish line at the top. There's 1.93 million people today that are on some form of that of continuing claims. So it's not their first week, but at least their second week getting it. Then there's the initial claims, which you see another one. It's pretty noisy, where there's spikes. Sometimes holidays impact things as well. But what we see here is that there's really not a meaningful trend in initial claims. Yes, we've seen a little bit of an uptick in the continuing claims, but when you start to look at this chart looks really bad, right? You say, oh, wow, there's almost 2 million people that are getting on some form of unemployment assistance. But then you look at it as a percentage of those that are actually unemployed, and you can see it's a pretty relatively stable number. And it's relatively stable out there because this probably feels really close to what we say as full employment. And if you look at it as a percentage of the labor force, when you look at how many people who are actively looking for as well as employed, it's a very, very low percentage. It's a little over 113 basis points of the economy. So we did say, okay, when we start to see recessions, like what level is kind of the percentage of the labor force that the claims comprise to really signal something. But I don't really think it's that level. I think it's the momentum behind it. And you can see there that, definitely as a recession lingers on, you get that momentum in this. And I don't really see there being momentum today. We still have to be on the lookout for it. But let's say if you took the average of what you need to be to get into the recession, well, that's about a 1.9%. You can see that it's volatile around the average as well. But that means we have to have another 1.6 million in there. So call it something north of 3 to 3.25 million. Probably is the number you should be concerned about continuing claims, given the size of the labor force today. So anyway, just something to think about. When you look at numbers, you got to remember there's a denominator effect sometimes. That's why we use a lot of ratios in this business. We got to compensate for the growing part of the economy. And so a lot was made out of the the BLS reports. If you look at that blue line, not the dark blue, but the lighter blue line, that's actually the BLS payroll report, non-farm payrolls. Some of that's going to be revised down, so that will actually probably converge down closer to these other series out there. I have to admit, I never heard of Revelio Labs prior to people talking about an economist talking to it a week ago. Threw it on here because I thought, wow, it does show like it has pretty good correlation to these other series. And for the criticism we've seen over ADP being pretty bad relative to predicting non-farm payrolls, after revisions, it's actually pretty good. And so once you get to final numbers, it tends to be a little bit better as well. And you can see there that you have relatively decent correlation there. So again, we don't have the government open. We don't get the data. Even once the government opens, they're still going to trickle that data out. It's still going to be a delay for a bit. So this is what we're going to have to contend with while we have this government shutdown. And so, again, the ADP reports, you can see here that there were job losses. Market kind of focused on this, but again, given that spottier track record with the BLS, this is all we had to deal with today. And so another thing to think about is just like the amount of openings out there, whether you come from like this Indeed, which is a publicly available site, or you look at the JOLT survey, which is something that the Fed uses as well. And you can see here that this is not just some precipitous fall off. And they're both, first of all, the Indeed is indexed to where we were going into the recession. So there's still 3% more job postings than there were back then. That's how to interpret that chart. But also from the JOLTS data, these two things have the same kind of picture and the same slope here. So even though we are somewhat flattening out a little bit here, it's not that we're having some precipitous drop for this incremental labor demand today. And so this kind of feels like, if you use like what a lot of economists call like an economy, a soft landing, it kind of feels like that's the way that labor is moving right now, once you start to look at the greater picture of everything together. And so a lot was made out of the BLS report. Goldman did some work here, so we'll credit them for it. And they just show you like what actually the initial number is, and once you take the revisions down, what it really looks like. And so once the BLS opens back up, when the government's back working again, we'll get the estimates on non-farm payrolls. And a lot of people are thinking the equilibrium growth rate is somewhere around like 70,000 jobs. So if you don't have 70,000, which used to be a very disappointing number, that's probably what we need to have kind of this replacement rate out there in the workforce. And you're seeing wage growth decelerate, but still, if you notice wage growth being roughly around 4%, regardless of which series you use here, what you find is that this is still a wage growth environment that's meaningfully better than what we saw in the post-GFC pre-pandemic period, right? And so even though we have elevated levels of inflation, because the inflation rate's been below 4%, at least over the most recent year or so, that means that the worker is actually gaining ground on a real basis. And so maybe potentially this is what's happening in some of that spending we're seeing out there. The bad news is these are all aggregates. And so unfortunately, tariffs, just like inflation, are very regressive, meaning that they really have a disproportionate impact on the disposable income of the lowest economic decile. And that's always the case, right? Just like with inflation, there's less money to go around. These are not inherently savers. People living paycheck to paycheck out there. And so unfortunately, they get another dose of economic pain. They got the regressive tax of the inflation. A lot of them happen to be renters. They don't get to participate as well in the boom we saw in the housing market. And then you add that on top of that the tariffs are likely to hit this cohort as well disproportionately. And so again, that's where you start to see some data. You're seeing larger defaults and delinquencies in lower credit scores, lower income strata, and that makes a lot of sense given how this pain has not been proportionately shared. It's disproportionately shared, and inherently these two things, inflation and tariffs, are both regressive. And so we talk about the real kind of wages, but also the consumer spending. So you don't have to use real or nominal if you're using the same deflator. It doesn't really matter here. It's just the numbers will move by the inflation rate. But you can see here that on a real basis, wages and salaries are actually lower than the consumption rate. And so spending has been greater than those incomes. So the question is that coming from potentially investment portfolios? Was there just cash that was accumulated somewhere? Is there something else going on here? Are they using credit cards? So again, it's always interesting to watch, but there's many periods where you get these disproportionate readings from these two series as well. And lastly, since the government shut down, just taking it back for the last 50 years to look at the shutdowns that we've experienced. Remember the 80s? The 80s, we used to not get along, but we got along well enough to get the government back working. We had some challenges in 95 with that kind of double dip recession there. 13 was a challenge too as well. But notice the most recent shutdown that we had was the longest in history. And so some folks are speculating that this one may go a bit longer. I know about 8 days from now is a big pain point because the military and other government employees that are deemed critical are supposed to get paid. And so potentially we'll see if that can bring us some ramification or some closure to this. So with that, let's move on to the markets and I'll talk about the portfolio. So that's the economic landscape. If I had to summarize that, I would say that the labor market is truly at a crossroad right now. I think that you have some signs where there's definitely demand is softening. We've seen supply soften somewhat. You're not seeing massive layoffs. You're seeing quit rates come down. Didn't reference that today. But when you start to look at all this, it kind of feels like the labor market's very balanced. But the Fed is still obviously concerned that you can't just cut rates by 100 basis points if you're having massive layoffs. That doesn't just cure the economy overnight. So I think that's part of the reason for Jay's risk management cut, as he called it this time. I don't believe in front loading. That's the Myron thing, is that he's saying that, ultimately, if we're going to go to 2%, we might as well just go there. We might as well get there sooner. The inflation shelters are going to roll over because of the immigration policy. Well, that's great. But what happens if you ignite those animal spirits and you cut rates too quickly and you get these speculative excesses again that lead to some form of inflation? So this is the battle that the Fed is trying to contend with. The market, though, has really kind of brought volatility down this year. If you look at for kind of the geopolitical risk, we see that all the spikes we saw during the tariff policy announcement back in April. But for all the geopolitical risk and everything we see in the marketplace, volatility hasn't really spiked since that point in time. In fact, that blue line, which is the interest rate volatility of the U.S., the implied vol of the Treasury market, actually has come down meaningfully. This has actually helped some parts of the market, specifically agency mortgages, which tend to The spreads tend to be correlated to rate volatility as well. But notice the credit markets. The high yield spread isn't signaling anything. The FX markets aren't really signaling anything. And so what you have is this kind of like eerie calm that's in the marketplace right now. When you look at back the returns, what you see here is that it's been a pretty good year in fixed income. You've been earning coupon. A lot of things have tightened in if they're spread product. So you've earned a little bit above that coupon. And you can see on the page, nothing below like 3.7 here. That's the riskiest part of the loan market. The things that have a 4 handle, most of those are either extremely short duration or floaters. So they don't have that interest rate component. You see kind of the treasury agency market. Notice how well agencies did to treasuries thus far this year. Some of that rate volatility has brought some spread compression in the market there. But look at also corporate bonds. They've done relatively well. Looking at IG as a cohort, 6.9, high yield at 7.2. Emerging markets, the big winner here through this period. A lot of that's duration that you see in there with the rate rally, and then the corporate market doing quite well also. So you pull it all together, it's been a pretty good year to be a bond investor. The weakest part of the market are those things that have been floating. Looking inside of credit, I consider emerging market, even if it's sovereign credit. Notice here that's the high octane stuff that's done the best. The one of the riskiest debt parts of the CLO market, the double B market, the triple C high yield market. I mean, it's really not that much different from the double B high yield market. It's just a few names that are the kind of toxic points in that market. But notice at the bottom too, those are all the floaters, right? Also, the lowest quality loans in the bank loan market have been the worst performer, but still generating positive cash flow. And in this instance, even if you've had a T-bill at the beginning of the year, you've actually out-earned the T-bill rate by stepping out on any of these risk spectrums as well. So the challenge with this is these are the backward-looking returns. They've been pretty healthy. Now spreads are getting tight. So where do we go from here? Well, let's start with rates. Looking at rates, we talk about getting rates down. And I want to focus on the bottom left-hand chart to start with at the 10-year yield. And for all this talk about Scott Bessent wanting to get the 10-year down since he stepped in, we're roughly where he's made that announcement. And so there hasn't been it's been a choppy market. The market's still trying to digest inflation to see where the overall economy is as well. What should be that kind of inflation premium and real yield on the rates market. But notice the back end of the curve. If you look at the 30-year on the right-hand side, kind of very close to the highs over the last couple of years. And you look at the other side at the upper left, and you look at the 2-year treasury, you notice we're near the lows of this cycle as well. And so the 5 years kind of in the middle. I mean, what you get is that as you move out the duration spectrum, you're getting a different perspective of where we've been trading over the last 3 years. And so what I'm seeing in this one is that the 2-year is really rooting for the rate cuts. The 2-year has been rooting for rate cuts. Look what it did, in the second half of 2024 when we got to these levels a little bit lower than we were today. It was about 3.5 on that rate. The 5 years hanging in a little bit better. It's thought of more as like kind of where that economy is running at the current rate of time. The 10-year is just sitting in the middle of this range, right? It's tough to break below 4 given where inflation is today. And then you got the long bond just giving you a completely different signal. And so I think this is an important thing for investors to think about, is just thinking about the way that the different parts of the treasury market are behaving today. And so we think that this trend continues, or we at least think that the front of the curve comes down more than the back end of the curve. And if you look at a lot of our interest rate positioning, it's reflected that way as well. And I'll talk about in that portfolio specifically. I talked about inflation. Even with the uptick in inflation that we've seen, even with the expectations of inflation running a little bit hotter, the bond market just isn't really pricing a meaningfully higher inflation rate. The one thing that has went up a little bit is in the 2-year part of the curve. I didn't show the 2-year here. It tends to be a lot more volatile. But we did actually add some tips on the 2-year part to our low duration strategies. And we did that because we thought that one, the break-even rate was way too low at that point. It got walloped after the tariff policies, and it really traded low for really throughout June. We thought there was good optionality in that. But we haven't introduced into the intermediate duration portfolios because we just don't see there being a lot of activity here. And secondly, you have to buy duration to get this as well. So we like the front end tips. We've had those on for a few months in the portfolio, probably since around June. And those are in the kind of shorter duration portfolio, or anything that's using has a duration inside of 2 years. But the 30-year I talked about, showing the chart of the U.S., but this is not a phenomenon that is just only exists in the U.S. There seems to be this kind of massive purging of wanting to own long duration paper in the developed world. And remember when people said Japan can never raise rates, they'll never go over 100 basis points ever again on the long bond. And look at just the tear it's been on as well. And so I think these are the countries with high debt to GDP ratios. These are also the countries that are spending. Germany's now a big defense spender, with their commitment over the next 10 years. And so what you're seeing here is the bond market's just saying, hey, maybe we should have more of an inflation premium. Maybe there is some risk of being paid back on the back end of these bonds. So again, something to watch about, that there is this correlation in the global developed world. I just plotted the spreads. The chart gets a little distorted because of the CCC loans. I thought about kicking them out, but I left them in here. But if you see here is that the year end is the diamond, the current is where we are on the box. You'll see in general, most boxes are lower than the diamond, meaning that they've tightened in on a year-to-date basis. And kind of the aberration is the CCC high yield market. It's a little bit wider than we started there, but it always commands a pretty hefty premium. But you can see this has been the demand for credit this year, and that's how you have such strong returns in credit. The dollar gets a lot of discussion points these days. This is the what you look at here is the effective exchange rate, using purchase power parity out there. And you can see here that even after the move in the dollar, it's still pretty elevated. It's almost still one standard deviation rich. And so using the real effective exchange rate, you can calculate this over the last, let's call it like 60 years or so. And that's where it starts to look at today. So then you can also look at it on the trade weighted dollar. So instead of using the effective exchange rate, you're actually balancing it for the payments here. And you can see here that according to Goldman, they have a model they have on fair value, very similar to what we saw in the previous one. You're seeing this kind of overvaluation of the dollar. So this is probably another thing that, bringing rates down probably brings the dollar down. Now, the downside to that is that probably also, by weakening the dollar, given we still import so much, right, it's going to put some inflationary pressure in the economy as well. So all these things they don't work in a vacuum. They all work in concert together. And so it's hard to see why, the policies we're pursuing today, why we should also be lowering rates. To me, it seems like there is some moral hazard there. And, students of history should dust off the case with Nixon and Arthur Burns as well to see what happens when you have a less independent Fed. So yields, I like to use this one. Pretty much what this tells me is that, hey, yields are higher today than they have been on average the last 10 years. A lot of that's the base rate, as I showed you. Spreads on the other hand are a little bit tight. If I look at the credit markets, a lot of the juice has been squeezed. And so we showed you spread on the other one. If you actually look at the yield, and these are yield to maturity or yield to worst on these assets, assuming no defaults, what you find is that really all the yield is concentrated in the lowest quality segment of each of the respective markets. So there's no double-digit yields unless you go to CCC high yield, CCC bank loans, triple B minus CMBS. And those, by the way, have meaningful default risk today. That's why they trade like a CCC asset. The lowest quality asset-backed marketplace lending deals, so consumer direct loans there, the double B CLOs. So when you put all this back together, or even the CCC EMFI, what you find is that really yield, quality yields around 5 today. The lower quality, that's called the riskier kind of credits, yield about 6 to 7. And anything beyond that is rife with risk. And so I get this question a lot about the public markets versus private as well. And I'm like, if someone's offering you something that yields 12, 14% in that private market, this is what the public market's offering there. It's got to tell you that's probably some commensurate risk out there. Again, not to criticize private debt or private credit. It's got a functioning place in our overall markets. It always has. But this idea that there's just this free lunch out there and these are just high quality companies that can't find financing. This tells you if you have a higher quality company and you can access public markets, why wouldn't you? These are the yields you'd pay today. So spreads, these are very tight. I referenced that. especially kind of the higher trafficked markets like high yield, IG. The U.S. has been an outstanding asset. The deleveraging story, it's all there. Percentile ranks, we're all in bottom decile on all of those things. Things are still cheaper in the structured products land. Things like agency mortgages, even after the run we've seen that outperformance over treasuries this year, finally starting to outperform corporates this year. But you can see here that really it's the stuff that ultimately is of the structured products ilk that has still, it's not the cheapest valuation, but it's less expensive relative to history than the others. So let's talk about the funds real quick, and I'll jump into a little bit of Q&A. So low duration bond fund. So if you look at this today, yields, they've come down over the year just because, again, spread compression, as well as some of the, you look at the 2-year treasury sitting at about 365-ish today or 360-ish today. You can see that we're still picking up relative to that part of the curve, about 4.5%. So again, high quality, out yields cash in today's market. Duration's about 1.5 years. As I mentioned, inside of that treasury portfolio, about 10% of the overall government allocation, about 2.5% of the portfolio does sit in TIPS, kind of on that front end of the curve, around the 2-year part of the curve. And that's something that we think is a nice insurance policy into a portfolio like this, just in case something happens with the resurgence of inflation. You look at our credit book, it's about 2/3 of the portfolio today sits in credit. Notice it's a securitized market, non-agency RMBS, the highest quality investment grade corporates in here. We still have a lot of CMBS in here. These are primarily AAA, AA rated. They're either very seasoned deals or they're floating rate like loans, like CRE CLOs, for instance. If you want to know what's in that portfolio, an example is our ETF DCRE. If you go out and look at that portfolio is essentially what we own inside of this sleeve here. So definitely one of our higher conviction trades this year. And so we have increased the non-agencies a little bit over that. CLO, we've been taking down to fund a couple of these other positions, just as spreads get a little bit tighter there. Obviously, we're thinking about the cutting regime that the Fed's on. How far will that go relative to forward curves? So we still like having a little bit of floater in there. But again, that's come down a little bit as we moved a little bit out on the fixed rate paper as well. We have asset backs in there. This is this one's going to be shorter than what you see in DABS, for instance, where this one just kind of that shorter end of the curve. So if you take the shorter maturity stuff inside it, that's what it'll look like. And then emerging market debt. So these are primarily corporate bonds. These are all dollar denominated. So even with our views on the dollar, the low duration bond fund is supposed to also connote low volatility. And so we only traffic in US dollar denominated assets. Look at the credit quality in the bottom right. Hardly anything in the below investment grade space. Some of those unrated are just securities that are just never got ratings. So I'd say at least half of those are in what we call roughly investment grade. But you can see we're just really not taking a lot of credit risk in this portfolio today, given where valuation is. So this I like to call the boring portfolio. It's exciting for us bond folks out there, but it's supposed to be boring. It's supposed to grind along. And the goal is to get you that yield to maturity from the diligent credit work that the teams do there. So a riskier side of the funds is the flexible income fund. So this is our credit portfolio that has a shorter duration in nature. The duration on this, you can see it's about 1.1 years. But you notice here, there's a meaningful pickup to the low duration fund, right? It's about 110 more basis points. It's a 5.6 yield here. And you can see that the asset mix is very credit heavy. We do own agencies in here in this portfolio because we sold some of our corporate bonds to be able to get into that as well. We thought that was a pretty interesting place to be for part of this year. So again, we started to build that position late last year. But again, heavy in the non-agency, RMBS, the CMBS, and CLO markets. So that those three alone make up almost 40% of the portfolio there. These are things that are in the non-QM space or non-qualified mortgages. These are a little bit further down the capital structure in the CMBS, not those BBB minus that we were talking about earlier, but getting a little bit more of that credit risk and trying to generate a better yield than the overall ag, but doing so with meaningfully less duration risk. And so you can see that where the ag has a duration around 6 years today, 1 3/4, about 120 basis points of pickup for taking this credit portfolio. I keep hearing the story. We run into managers, or we run into our clients, and they're telling us about other managers. Everybody's talking about high quality. This is our credit fund that we can buy rates, we can buy other things, but we lean more heavily into credit here. And usually about half the portfolio is below investment grade. And you can see here today that the below investment grade bucket is really only inside of about 23% of the fund, or 24% of the fund. So the idea here is that, again, what we're seeing in the credit markets is that we just don't think that this high octane debt is really priced for a lot of imperfections. It's pretty close to perfection. And so that means we want to gravitate into higher quality assets at this point in the cycle. And that's what we've been doing over the course of really the last 2 years. Core fixed income fund, DBLFX. This is the fund that goes against the ag. You can see here yield to maturity about 5%. We're about a half a year underweight the duration of the index. We're doing that by two things. One is we have shorter credit in the portfolio, so it's a lot of that securitized space. We've taken off some of our back end kind of duration positions that we just have really started to really loathe the 30-year. And we have steepeners on in the portfolio. We have either 2s30s or 5s30s or some combination of those in the portfolio to try to take advantage of some of this potentially, an aggressive Fed on the hike. On the cuts. I've just got hikes in my mind. Aggressive Fed on the cuts, or you get this lack of independence where all of a sudden you get the shills inside the Fed. They're just using the administration's policy, bringing rates down and potentially causing this kind of inflationary shock to the market. You can see that on the day that they announced that President Trump said he's going to fire Lisa Cook. You see that there was some movement, but go back to the day he said he's going to fire Jay Powell. That was the first time there was the market test. And you saw in that 5 minutes, they had to scramble and say there's no intention to do so because yields just started to spike on the back end of the curve. So again, trying to think about ways to have some of that. It's kind of an inflation policy. It's a little bit of an insurance policy in there. And we have pretty high conviction that we think the curves continue to steepen as well. You can see our credit's a little more balanced than what you see in the flexible fund. It's about half the portfolios in credit. A lot of times we like to run this at about closer to 60, 65% of the portfolio, just given where valuation is and how cheaper agency mortgages were. We just think that having this mix today just makes a lot of sense. Our government, a lot of that sits in either steepeners or it sits in the belly of the curve. We don't have a lot of back-end duration positioning, as that's something that we've been trying to really just get rid of out of most of our portfolios. You look at the below invest grade, same thing here. Normally we'll carry about somewhere between 25 to 35% below investment grade. And today that number is in the low teens. So again, it's that consistency of how we're approaching the various markets. It's just the difference is what the strategy that underlies vehicles are, but they're all kind of following the same thesis of, let's not try to get super risky today. Let's generate yield. It's a challenging environment. There's massive uncertainty. There's a lot of unknowns as we go into 2026. And so let's try to find shorter cash flows, things that make a lot of sense for us that we can analyze and that can deal with some of this fluctuations in the ever-changing economy. And lastly, DB&D. This is the ETF of the opposite core bond there. Very similar to the mutual fund, a little bit shorter duration, 5.5 on the nose here. I give up just slightly a little bit of yield there. But again, roughly about a 50 basis points, 55, I think is when you take out the rounding, yield advantage today. Very similar posturing, same teams running this, same portfolio managers, analysts, traders across the desk that are generating the ideas for these portfolios. So with that, those are my prepared comments for today. I'll move on to the question section, and I'll have our compliance folks give you all of our nice disclosures. Let's see, that says, with the current economic backdrop and position and cycle, what would happen to see credit spreads materially widen? I think what you have to see to get them to materially widen is I think you have to have degradation in the economy. I think you have to have some kind of erosion from the consumer. You would see that first in the labor market. You would see that there would be more layoffs out there. That would be a choke point. When the layoffs come, right, then you have to curtail consumption. So I think it's that domino effect, but you're just not seeing enough of it yet. And as I mentioned kind of briefly, we've seen a deleveraging of the capital structures. We've seen in some instances companies pay down debt. We've seen a booming equity market that's helped bring some of to help kind of delever the company as well. Obviously, that part can, if equity markets give back, there's not as much deleveraging there. But I think that you just need to start to see really, some misstep in the overall economy, and we're just not there right now. And so again, we're all on watch. We're trying to read through the various data point, but I think there's a reason why people are saying, look, there's all this insanity going on around the governments, all the spending. Maybe it's better to own a corporate bond, right? So some of that psyche's in there. I don't like that logic, but at the end of the day, again, we do own high quality yields, so we're in the same kind of boat here in some manners. It's just that we just kind of step back and taking our foot off the accelerator of buying the stuff that's really, really getting tight. So hopefully that's helpful. Let's see. So someone's asking, what would be the outlook for fixed income if the Fed's independence is no longer there? I think you just have a more volatile rates environment. I think what will happen is that I think you'll start to really think about, okay, what ultimately do these policies pursue? Are they more inflationary in nature? And you're going to get much more whippier responses because the Fed's losing control of being able to kind of help dampen that volatility. So, I think that you're going to see some short-term noise in there. It's probably bad for the back end of the yield curve as well. So it's kind of another reason, as I mentioned, thinking about the kind of steepener trade in there. It's a way of kind of getting yourself some protection. And if the Fed does also, cut rates meaningfully, typically when they do that, the front end moves more than the back end on a basis point basis. So if you have it on the right hedge ratios, it can work out quite well. So it's there have been periods where there was a lack of independence. Those happen to coincide with periods of higher inflation, but we'll have to see. I mean, look, the other thing is, does the Fed do yield curve control? That's another thing there that doesn't help my thesis on the steepener. But if you start to see them cut rates meaningfully and the back end's not responding, maybe they step in and do some more quantitative easing. They do it from a yield curve control perspective where they're buying certain parts of the market to target those yields being lower. And that could be easily be the 10 or the 30-year part of the curve. So anyway, that's my comments. That leads to the next one. Great. Next question. What would lead me to get more constructive on the back end of the curve if I thought yield curve control was coming? Again, that's probably the thing about, like, let's say we're right. Let's say you get Fed, you get the administration gets its people on the Fed. You have a biased Fed where they're just going to be dovish. They're doing it to implement policy for the administration. If they do that, then the question is, do you take that trade-off, right? And I think you probably want to. And then the question is, now do you turn around and buy the duration? Because their next step is to go out and to start doing yield curve control. And so that's probably right now the thing that would get us the most constructive. Or if we find a new revenue source, we need to actually bring more money in than we spend in this country. And right now we're spending 6% more, or 6% of GDP, more than we're bringing in. So that's a lot of money out there. So we need to stop running, things that are like, $2 trillion deficits each year. That would make me a lot more constructive. But 1.98 isn't going to get there. We're talking about you have to really take it down meaningfully. Aggregate. So next question. Aggregate consumer data looks okay. Circumstances. K-shape economy. Where are you vis-a-vis credit quality? Yes. It's kind of what I'm getting at here too. Why I bring out some of those instances that, I don't want to bet on low-end consumer right now, simply because, again, the regressive nature of the inflation, how much they got hit. And then on top of that, now we're talking about the tariff impact. It's obviously much more punitive on that side. So I do think that that's the case with credit quality. You want to make sure that you're getting things that are exposed to kind of more broad-based than narrowly on that side. And I know there's some missteps in the, and there was some fraud in the ABS market recently of, loans being double and triple pledged in some instances. And so that looks like a one-off for now. But again, I think there are ways of just, you probably want to avoid some of those subprime cohorts. And you're seeing that it's not really reflected meaningfully in the pricing. And so you don't give up a lot to avoid that today. So next. Someone's saying in DCRE, some of the maturities are longer, they preferred. No, they're actually the maturities because those are CRE CLOs. And so since they're loans that are collateralized in the CLO market, but through commercial real estate, they have to use their stated life, which is 30 years. So just like a mortgage, if you look at that, you'd see the same thing. You don't see as much in the bank loan CLO market, the syndicated bank loan market, because those loans are shorter in nature. So it's just this thing about legal lives in there that is driving that. So if you have more questions, just reach out to us at fundinfo@doubleline.com. Are the treasuries still the safest asset to own even in a shutdown? That's a great question. We do own treasuries. We think there's a meaningful place for them. But we're seeing a lot of people are preferring gold these days, right? Too, as well. So look, I'm shut down if people aren't getting paid. Maybe we're saving money this way. So yeah. So let's see. The next person asking about AI. Yeah, we have ChatGPT and the likes. We do certain things, but it helps with kind of screening and stuff. But all that stuff will be supervised by human beings still. And so what should expect for differences between DBLTX and DBND? So DBLTX focuses on the mortgage market and the securitized markets, where DBND focuses on all markets. So DBLTX tends to use mortgages on the agency side as the ballast of the portfolio, and uses the securitized credit markets, typically some of the highest tranches there, the senior tranches, to express those credit views. And then DBND looks more like a traditional core plus fund, where we invest in those things. We'll go down in the capital structure as well. We buy high yield, we buy emerging market debt. And you can see that I didn't really mention it when we talked about it, but we actually had bought our first amount of local currency emerging market bonds over the last couple of months. And so it's something we haven't done in, really since we've been at DoubleLine. It's something we talking about doing. But today we think that that's a good opportunity set. So there are some differences. I would expect through a full cycle DB&D to have a little bit more volatility, just like you've seen historically with DBLFX. So with that, I want to thank everybody for tuning in today. I know it was a little bit earlier than usual. So thanks again. Everyone take care. Good luck out there, and enjoy your autumn while it lasts. Take care now.